Okay, hi everyone. This time around, we will be looking at financial indicators. This is a very important topic when it comes to performance evaluation because performance is evaluated either through financial indicators or through non-financial indicators. There's a separate channel on non-financial indicators. So today we'll only be covering the financial indicators. Um, we'll be moving on step by step. So what are financial performance indicators? Financial performance indicators concerns an organization's profitability, liquidity, and financial position. Many stakeholders are interested in organizations' financial performance. So usually, whenever you come across an exam like this, the goal will be maximization of shareholders' wealth. If the shareholder is being or not, this is something that you will analyze by assessing the financial indicators that will be given to you in the question. Speaking of shareholders' wealth, it comes through two sources, dividends and changes in the value of shareholders. But at the same time, the shareholders are also very interested in the profitability of the company, the liquidity of the company, overall of the company performing financially. So changes in value of an organization shares are influenced by the organization's current and forecast financial position, which is using financial ratio analysis. So today we'll be looking at different financial indicators which shareholders are interested in. So firstly, we'll be covering profitability ratio, return on capital employed. So return on capital employed is basically operating profit upon. I'm sure you guys have studied this before as well. Capital employed into 100. It basically assesses how much profit is being earned in relation to the capital that was invested into the business. Also, how do you calculate capital employed? Calculate by total assets minus current liabilities. That's how you calculate your operating profit, or you can also calculate your capital employed by shareholder equity plus long-term liabilities, whatever is available. So that's what return on capital employed in a nutshell is. I'll also pinpoint some of the facts that um, ROC can also be calculated with profit for the year. So you have to pick whatever is appropriate. Capital employed can be based on the carrying values or the replacement cost. So use whatever is provided in the question. Now, what is the meaning of capital employed? It shows the returns generated on a company's capital, and this can be compared to companies in the same industry sector or the company's capital cost. It is always appropriate to use opening capital rather than average capital for some businesses. For example, significant investment in non-current assets takes time to generate cash returns, right? What are the advantages of operating capital? That it is easy to calculate, it is used by external analysts, it relates to the profit earned to the amount of capital invested, and a higher ROC should lead to higher shareholders as well. So it is consistent with the organization's main objective. And most importantly, the prime advantage of ROC is that it is a relative measure. So you can compare, easy to compare. Disadvantage for ROC, I would say that the use of different accounting policies can impact profits and employee accounting policies. Also, some what happens is that managers may take action to manipulate the measure, like delay investment in plant or machinery, and which can eventually harm the organization in the longer term. Okay, coming to the next ratio, which is gross profit margin. This is basically as simple as it can get. Gross profit upon net sales into 100. A falling gross profit means if it's zero, it means uh, the cost of goods sold is increasing or your sales are decreasing. At the same time, a high margin means um, your cost of goods sold is increasing or your sales are increasing. Operating profit margin is also very simple. It's your operating profit upon your sales into 100. So these both measures are relatively very simple. But if you are being asked to calculate, you can easily calculate these measures. I think there's nothing more to these profitability ratios. I'll move on to investment ratios. Investment ratios, first one is earning per share. So how do you calculate this? You calculate this by profit after tax upon total number of shares. EBITDA is earning before interest, tax. It's EBITDA. It has a D also. Depreciation and amortization. Coming back to EPS, so the advantages of EPS are that easily understood by the shareholders. So you can say easy to understand. Uh, the figures that you need to calculate this ratio are always available. It's also very useful for comparing performance of a company over time. Unlike profits, EPS considers the changes in company's capital. It also enables comparison of company share prices using a price earning ratio, hence it's therefore widely used for financial markets. Then we also have total shareholders return. Sorry, I'm just on EBITDA. So when do we use EBITDA? It is used during business valuations. It is believed to be a good measure of the business underlying performance. It is regularly used as a performance measure in retail. So I can give examples of the where EBITDA is used. So firstly, it's used to value companies for acquisition purposes. Value of the company is calculated by taking multiple of EBITDA by ignoring the financial charge depends on capital structure rather than underlying business potential and depreciation. It is argued that EBITDA gives better indication of ability of the business to generate operating cash flows. It's also used to assess an organization's ability to service its debt. Amortization and depreciation are non-cash expenses um, and added back to the profit. So it provides a more accurate indicator of organization's ability to generate cash. Total shareholder return. Shareholders hope to benefit from share price growth and receipt of dividends. Together, the combination of dividend and share prices may be referred as the total shareholder return, and this is the formula that is used for it. It's not a part of a syllabus, some people say, but if you want some professional marks, then this could be a great ratio, especially if you have the data available. Ratios, these are also some of the very basic and simple ratios. So this is current assets on current liabilities. It basically measures how liquid the company is, like how you can your assets to pay off your liabilities. Also for names, besides the fact that it excludes inventory. So this is a better because inventory is the most liquidable asset. So this they want, if the company wants to see that besides inventory how liquid they are, this is to be considered. I will just need a minute, please. Okay, yes. Coming back to the, so interest cover is a number of times interest earned. How is it calculated? By EBITDA upon your interest expense. Basically, it helps you that how many times you can pay off your interest, your profits. A very simple ratio, but these simple ratios can help you earn a lot of marks, especially if the question is asked you for financial performance indicators. Move to debt ratio. So there's just one ratio that is the most important one, and which the one that I've highlighted. So this is debt upon equity into 100, and you'll be calculating this a lot. So this checks that how much of equity is coming from loans. The lower this ratio, the better. Also, if this ratio goes beyond a certain percentage, for example, if it's 45%, then it will be difficult to acquire loans. The holders' confidence will also be low, because what if you default and you're unable, because 45% of your equity is covered from debt. So what if you're not able to bear the debt, and what if you're not able to bear the finance charge and you default on it? So this is a very important indicator, and especially if your question is telling that, oh, this is deciding to take a loan to finance the launch of this product, then you need to bring up the point of the gearing ratio, that how much is the gearing ratio, how much heavily the company is relying on its debt. So these were a few of the basic financial performance indicators. Next video, I'll be covering economic value added, which is one of the major indicators for analyzing shareholder wealth, if it is being maximized or not. We'll also be covering net present value, internal rate of return, modified rate of return, all these complex financial indicators. So please stay tuned and don't forget to subscribe. Thank you.